Okay, so what's going on here? Let me see. Oh, share. Okay, all right, here we are. So this is exercise, for example, from chapter 8, right? This is a good exercise, basic exercise. So again, all of these are recorded on Blackboard, but anyway. So this company is making products very popular, shown in the budget sales. What's the question? What is the accounts receivable? Prepare schedule expected cash collections from sales by month and in total for the second quarter. What is the accounts receivable balance on June 30th? Okay. So we can go straight to accounts receivable. Okay, let's go question 1 first. So we have these months here, April, May, and June, and the question is, what's the total for the quarter, meaning for this quarter, ending June? And we said we need to know definitely for the exam how to collect our cash, right? So that's always a question on the exam, for example, how to collect cash. So to collect cash, we have to look at what the information that we are given, the policies. So the company has learned that the 20% of month sales are collected in the month of sale. Another 70 collected the month following sale. The remaining 10% collect the second month following sale. Bad debts are negligible, can be ignored. February sales total 230 and March sales total 260. So why are we given here February of 230 and March of 260 when we are asked for the second quarter, which includes only April, May, and June? Well, why? Because we have to collect some months in April. We will collect some months that are not just April, right? What are we going to collect? Well, we are going to collect 70% of the previous month, which will be March, and we will collect 10% of the month, 2 months before, meaning February, right? So how you set this up, again, it's up to you. I have a little bit constraints here, of course, with PowerPoint, how to, but I think this is a pretty good way to set up the problem. So you line up, for example, all of your sales here, and you say February, March, April, May, June, 230, 260. And then kind of you just follow, draw arrows or whatever you want to do, and look at these directions that you're given, these policies for the company. So how much are they collecting? Now, again, remember, you are interested only in this April, May, and June thing here. So let's say you start with April, right? Let's say you start with April. And you ignore February and March. But if you line them up here, it would help you to remember, why did I line them up? Do I need them? Yeah, maybe I need them. So you look at your policies and you ask yourself again, will I collect anything from March later? Yes, I will collect something later. Like when? Well, I will collect something in April, and I will actually collect something also in May, right? So it helps you at least to remind you, because if you jump straight just into April, which you can start with April, sure, and you can do even May, but at some point you would realize, well, I need some other amounts here. So you start with April and you say, well, the sales are 300,000, 20% will be collected in the month of sale. That's 60,000 here, right? And then 70% of April will be collected when? In the following month. That's 210 here. So you see, this is April here, collecting April. Collecting April. Again, you can organize this whichever way works for you. You can start with April here on top, right? Start with April here on top, 60 to 10, 30. Line it up here. The reason I put it in this format is because kind of following in a chronological order, right? So March has 260,000 in sales. 52 will be collected in March. And then 182 will be collected in April. And then 26 will be collected in May. See, so this is March here. This is March here. Again, simply in chronological order because this is February. Now, do you care about these amounts? You don't, really. You don't care about these amounts because you don't care about March and February. You care just about the second quarter. Do you care about this amount here? You don't. But again, I'm putting them here because so you see that they are there. They exist. Now, do you need them or not? That's up to you to decide. Well, clearly you don't need them. You don't need these amounts here. You don't need them because that's not the question. Question is usually, let's say, what will be your collections for May? Right? What will be your collections for May? Or, okay, in this case, what would be your collections, total collections for the whole quarter? So the answer would be this here. So clearly it's different. You see, 1,021,000 is different from 1 million here that are sales. Really different from this 1 million quarter total. And why is it different? Well, because we discussed this last time, because you're collecting some months here. February, March, you're collecting in this quarter. And then on the other hand, you're not collecting everything from June. And you're not collecting everything from May, actually, right? And that will be your accounts receivable, things that people still owe you. So again, you organize this whichever way works for you. But it's good to organize it. I guess that's the point I'm making. Instead of just kind of just sloppily kind of just randomly punching numbers into your calculator and then just writing down on some corner of some page, and then that's how you miss things, or how you miscalculate things or add up things in the wrong way. So anyway, so April is here. We are collecting April here through April, May, and June. In April, we will collect a piece of March here, 182,000. How did we get this? Well, that's 70% out of these 260. And we will also collect 23,000, which is 10% of February, which is here 230. Okay, so this is how we get these numbers. So you can go through this on your own at home. And then March also, we will collect 10% here in May. So for example, if question is how much did you collect in May? Well, you would collect in May 336. How? Well, 36. You would say, okay, what am I collecting in May? I'm collecting 20% of my sales, which is 100,000. What else am I collecting? I'm collecting 70% of April, which is 210, 70% of 300. And I'm collecting 10% of March, 26, 260,000, 10%. Total 336. That's your answer. Boom. So that should take a minute, right? That would be a very straightforward question. A minute. June, etc. Now, account receivable, the easiest way, instead of, I think Munira was saying she has her own method, which is great. But for example, you might waste, the question is, what's your account receivable? Now, if you start doing all of this, you start doing all of this, all of these numbers here, I mean, that would take you a lot of time. It wouldn't make a lot of sense, right? Do you need all of these numbers? You don't, if you're looking for accounts receivable. So you know what accounts receivable is. You say accounts receivable is something that I did not collect at this point. Okay. So what's the accounts receivable? Well, you start backward, right? I'm not saying that this is what she would do. I'm just saying this is what you might do if you are kind of, wasting a lot of time repeating things or being very, very detailed, which is a good thing. But in this case, if you have to work fast, then it's not a good thing because a lot of information is irrelevant. What's the accounts receivable? Accounts receivable is that's something that we did not collect in this period. Well, what is it that we did not collect? Well, you start from your instructions. So you say in June, what is it that I did not collect in June? Well, I did collect 20% of June, but I did not collect what? 70% of June and 10% of June. I broke them down here in two pieces so you see that we are collecting them in July and August. But actually, you would just say, well, 80% of June we did not collect. So 80 times 200 is 160. So that would be 160 here. And what else I do not collect? Well, let me go one step back. Okay, let me go one step back. May. What did I collect in May? Well, I collected 20%. And then 70% of May I collected in June. Okay, good. So 20% I did not collect here. I will collect it when? In July. So that's 50. Okay. So you have 160 plus 50. I would probably go a step more further, just kind of to make sure, to be sure, and say, okay, April, how about April? April, I collected 20% in April. I collected 70% in May, and I collected 10% in June. So at the end here, I fully collected April. So that's not accounts receivable. So what's my answer? 160 plus 50 is 210, or in this case, 190 plus 200 is 210. Again, just breaking it down so you see that it deals with July and August. But I mean, you really care just what's the total amount for these accounts receivable at the end of this quarter, and the answer is 210. Okay. Any questions?
No, Professor.
Okay. Yeah, so you have to kind of work with this fast. You have to be comfortable, again, setting up things. Okay, next question. Prepare a production budget by month and in total for the second quarter. Let's go quickly through this. Production budget. Production budget meaning how many units we will have to produce. Okay, so we are not asked here for materials. We asked the company is in the process of preparing a production budget for the second quarter. Past experience shows the inventories, and so we are not asked for the materials. We ask for units. How many units do we need to produce in this quarter, second quarter? Again, usually the question would probably be, how many units do we need to produce in June or May or something like that? But it might be for the whole quarter. Okay. So this is the quarter, April, May, and June. Now, as you know, as we discussed last time, the units that we need to produce will more often than not be different from sales units. Unless the beginning and ending inventory is the same, then there will be no change, because then we are just moving in inventory the same that it should go out to the next month or next period, and then sales are sales, so there's no difference. So there it will be the same number, but more often than not the number is different, right? Because what's the point? What would be the point of asking a question? So we say, okay, we have our sales here, units, no dollar amount, right? But I mean, it can be a dollar amount too. So units are translated into dollars. It doesn't matter. But this is the number of units figure, and it says what the past experience has shown that the end of month unit must equal 10% following month unit sales. 10%. So we need 10% of the following month's safety cushion, safety inventory, right at the end. So as you can see, I reversed here a little bit the equation from the chapter. So I put beginning inventory on top here, because as I said, kind of it makes sense for a lot of students to go in a chronological order. Beginning inventory kind of is beginning. So, but you have to remember that then this is a negative sign because you don't need to produce these units. So that's fairly simple, right? Ending inventory you need to produce because you need the safety cushion, right? Or I put it in another format, which kind of maybe makes not more sense, more sense, but maybe it's most friendly, right? So you always start with sales, and you say, well, I have to produce my sales, and then maybe if there's any difference in inventory accounts, then this will either reduce or increase what I need to produce. But I have to start with my sales. Okay, so you start with your sales. Let's say you're talking about May. You will start with 75,000. Okay, so I want to produce 75,000. Do I really need 75,000 to produce? Well, let's see. My ending inventory for May has to be what? Has to be 10% of following month. Following month is June. June has 90,000 units in sales predicted, budgeted. So 10% is 9,000. So I need to produce my sales plus I need to produce 10% ending inventory. So that's total of what? 75 and 9, 84. Now I have 84 needs to produce. However, something came in here into this month in May, beginning of May. What did come in? Well, the beginning inventory for May, which was the ending inventory for April, which we see here, beginning inventory for May or ending inventory for April. Ending inventory for April is same as beginning inventory for May, right? It becomes beginning inventory. So we will deduct the 7.5, right? So we will get our answer of 76.5. So again, you're wondering, well, he's switching now. This is here on the bottom, this is here on the top. How is this? Well, I'm just giving you again two different ways to look at this, but the number is the same, 7.5 minus 7.5 minus. Just kind of whichever order works for you. And then there's another one which we covered last time in the main lecture. So you have three kind of ways to, if you want to set this up, but you're not setting it up actually. You know, it's not like it's some kind of format that is set in stone. Again, you might be doing this just on your calculator and just writing down on the margin of your paper, but this way things might get messy, and you get lost, and especially if things are going like in collections or payments, across a couple of months, then you might even copy a wrong number. So I mean, when adding up things, so it's not like these formats are written in stone. It's like you understand what you're doing. Well, I need to produce my sales, and then I need to also add some stuff here for the ending inventory, but I do not need things that came in because I have them. It's just, so that's my answer, right? So the answer here is the same, 76.5. What did I say last time? For example, this number here, the inventory at the end of March was 5,000 units, meaning here March ending inventory was 5,000. Again, do we need to be told this? No, we don't. See, and a lot of students, again, okay, so we are not told this here, for example, in this problem. Let's say we are not told this. Well, a lot of students will now, they know this procedure, for example, what we just described, but they will be stuck with March. Where is March? I don't have March. I don't have March ending inventory. I cannot solve this problem, right? Well, you don't need to be told that ending inventory for March is 5,000. You don't care about March. The question is May, for example, or the question is April. So you don't need to be told what March is, because what do you care about March? If you have this figure here, 50,000, April, because you know the 10% ending inventory was it, but as I said last time, it's like a shortcut in a brain. Well, you get stuck on ending inventory. I need ending inventory here. Yes, you do, but you don't, because this ending inventory is beginning inventory for April, and it's based on what? It's based on April, actually. It's not based on March sales. It's not based on March. It has nothing to do with March sales. It has to do with March units to be produced in March, but that's not the question. And you cannot answer that question, because for that, you would need to have March sales, right? And then you can get beginning March also inventory, and then you have ending inventory here. But you're not asked this question. So you say 10% of 50 is 5. So it's 5 here. It's 5. You don't need to be told this 5. So that's kind of, again, not a trick, but just a tip for you. So you know that you don't get tripped on things like this. Waste time, basically. That's all. Now let me see. Why are we given July? Why are we given July? Anybody? Why are we given July if we are looking just for the second quarter?
Because we need to know what the ending inventory needs to be.
Okay, very good. Who is this? Mitchell?
Yep.
Excellent, Mitchell. Yeah, I don't see the screen thing, but I recognize the voice. Great, excellent. So, well, we need July because we need to have ending inventory for June, right? Ending inventory for June, and ending inventory for June will be based on July sales, which is 10%, 8,000. Okay, any questions? Okay, what is this? Budget. You need to know budget, we said. I mean, you need to know budget. The whole chapter is a budget. You need to know cash budget, cash flow budget. So, I mean, with a cash budget, you're usually given all information except now you need to borrow something and you need to repay things. So that's the deal with the cash budget. Again, nothing else. Of course, you need to carefully add up things. So if the question is What's the budget for the second quarter? Well, let's start with everything because the questions here is for the upcoming fiscal year. But basically the question ends, for example, here because everything is kind of clear. Clear here. There's nothing here borrowing or stuff. So so for example, what's the ending cash for the second quarter, for example, is the question. Okay, so we start now. So you have to, of course, calculate these correctly here, but that shouldn't be difficult. I mean, that's those things that you're given. Now, there might be some items somewhere like depreciation or something. So, you know, you should not deduct this. I mean, you should not include this in this cash. This is an expense, but it's not a cash outflow, right? So that's something to keep in mind. That's in the lecture. So for example, for the first quarter, we have total cash receipts and then disbursements of 260. So we are told, and we have beginning cash of 220. So we have beginning cash of 20. We get total cash receipts of 180. So we cash available of 200. And then we have total cash disbursements of 260, right? Okay, and it doesn't say anything about any depreciation here or anything that we would deduct anything from these 260. So reduce these. It says cash disbursement, right? So it's not expenses. Expenses are 260, but 30 of those is depreciation. Well, then in that case, cash will be 230. 260 minus 30, 230, right? So you need to review this in a lecture. So here we have 260 cash disbursement. So we are basically short $60,000. So we need to borrow money, right? Borrow money to pay for this. We have to pay for this. What's the policy? The policy of the company is to have at least $10,000 at the end of each month. So we need to borrow 60 to pay for our expenses, but because we need 10 at the end, so we need to add those 10 to 60. So the total borrowing will be 70, right? If we borrow just 60, then we will have here 0. 60, we borrow 60, we get here 0. We pay for our expenses, but we don't have anything left, which we don't want. Okay, so we borrowed 70. So now 10 will become our beginning balance for the second quarter. We have cash inflows of 330, so that's total of 340. We have cash outflows of 230. So now we have 110 excess, or we have positive cash of 110. Okay. What are the policies in terms of interests? You would probably read this right away when you're reading the question, but they borrow at quarterly interest of 3%. So each quarter they will pay 3% on the money they borrow. And we said that in this class and for these type of problems, unless you're told specifically, which should not happen, we always borrow. Remember, this is a budget. We are planning this, so it's not like, well, you might ask a question, well, how do I know when I'm gonna, well, this is a budget, right? This is not the real thing. We are planning. We are planning, and we are predicting that we will need 70,000 to borrow for the first quarter. So we will borrow it here at the January 1st, first quarter, January 1st. And we will repay it at the end of the quarter when we are repaying, when we have the money to pay for it. And we have enough money here to repay full 70. So it will be at the end of second quarter. So we have 2 periods here, right? 2 periods. Why this is important? Because the interest will be calculated on that basis, right? If we just count, let's say here that we borrow this at the end of the first quarter, then we would just have 1 period. So we would just have 3%. 3% of 70,000 would be 2,100, but that would not be correct, right? we have two periods. We borrowed at the beginning of the period when we need the money, and we will repay it at the end of the period when we have the money to repay. Again, why? Because I mean, this is a budget. We know that we will be short 60,000 here first, and then 10,000 for the ending, so 70 beginning. Anyway, so that's two periods at 3%, so that's 6%. 6% of 70,000 is $4,200. So your answer is here 110 minus 70 minus 4,200 for interest is what? $35,800 is your answer, for example, for the second quarter. So that would be your answer. Any questions? Everybody's good?
Excuse me, Professor, can you please repeat? Oh, okay. Do
Yes.
you want to repeat again? How did you get the interest of 4,200?
Okay, you will look at this online and narrate the lectures again. But 70,000 is borrowing. We have two periods, first quarter and second quarter, two periods at 3% each. That's 6%, right? 3% for the first quarter and 3% for the second quarter. 6% of 70,000 is 4,200.
Okay, thank you, Professor.
Sure. Exercise 8.9. 8.9. What is this? This is balance sheet. Okay, we are preparing balance sheet here. This is a good exercise. This goes through 2 slides. This is a good exercise, so you see that so you see how to find things when they're missing, right? Same like you did in first part of the class. You had to figure out things that you know from knowing your material, and from given information. So prepare the balance sheet. Well, we are given here a bunch of numbers: cash, accounts receivable, supply and equipment, accounts payable, common stock, retained earnings. The beginning balance of retained earnings was 28. Net income is budgeted to be 11,500. Dividends are budgeted to 4,800. So for this, you need to know that those couple of slides in the lecture about balance sheet and about income statement and retained earnings, especially, because that's kind of the item that is usually tested, and it's usually the point here. Otherwise, you're just adding up numbers. So first, for example, here you can immediately say, well, let me figure out first my new retained earnings, right? New retained earnings. Well, a retained earnings here is a question mark, right? So let me see if I can figure out one of these two. Can you figure out cash? Well, you have to remember, again, this is the part of accounting 2101, but that your assets will be equal to your liabilities plus stockholders' equity, right? So these numbers will be equal. These numbers will be equal. I mean, that's the extent you need to go through. So you don't need to go review 2101 class to do a couple of problems here and for this budgeting chapter, right? So that's the extent you need to know and or to solve this problem, right? So now you say to yourself, okay, so what are the assets here? Well, the assets here: accounts receivable, inventory, equipment, accumulated depreciation, contra asset. And then what's liabilities? Accounts payable. And what's in the stockholders' equity? Common stock, retained earnings. Okay, so these here have to be equal to this here. I mean, plus cash, of course. Yeah. Cash is an asset. Okay, so these here You have to be equal to these down below. So this is how you figure out, okay, so I need one of these two numbers. I need either cash or retained earnings. Now, you cannot guess cash. You cannot just guess and plug in whatever you want, right? How can you do this? It says here net income. Does that mean cash? No, that's net income. Not everything is cash. Some of it you still have to collect, as we know. So, okay, but what do I have then? Well, can I figure out new retained earnings? Well, yes, I can. 28 is my beginning retained earnings, 28. And then you had income of 11,500. You will add to these retained earnings. So that's 39,500. But you paid some dividends, 4,800. Or it says budgeted. This is a little bit kind of too detailed, but once you declare dividends, you deduct. So just remember. So that's 4,800. So your ending balance is 34,700. Okay. So this is your retained earnings. So now that you know 34,700, you just add these 34,700 here, because the question might be what's your cash, right? Instead of what's your budgeted balance sheet, which is the same thing, right? So now you would add 1,800. Okay, let's go to the next slide. I think it's probably there. It should be there. So we have our retained earnings of 34,700. Okay. So we have our retained earnings of 34,700, and we had our common stock of 5,000 before. 5,000 here, and we have 1,800 in accounts payable. Okay, we add them up together. Total stockholders' equity 39 plus 1,800. Total liabilities and stockholders' equity 41,500. So now that we know our total assets are, total liabilities and stockholders' equity is 41,500, we will know that our total assets are also 41,500. They must be equal, right? And then we say, okay, what are the numbers? Let me see, what's this next slide? That's a new problem. Okay, what are the numbers? Well, the numbers here are on the previous slide. Accounts receivable 810. Plus inventory plus equipment, and then we need to deduct accumulated depreciation, right? Why? Because, well, this is a contra asset account, meaning it decreases our assets. This is accumulated depreciation, if you remember this. So again, this is a little bit of a review of 2101, the basic stuff. If you're having trouble with this, just do the best you can. Work on your strengths and work on other things that you don't need to spend a whole day now on this. You're not going to be, this is not, again, 2101. So you're not going to be asked 10 questions on, let's say, balance sheet in the budgeting. It's just one chapter and one piece of it. But of course, you want to do the best you can. So you would reduce your assets for 16,000. But then this number that you get, and the difference between 41,500 would be your cash, right? So that's that. So you have here accounts receivable of 8,100, and you have supplies inventory of 3,200. So you have current assets. You don't need to worry. Are they current or non-current assets, or that's not the question here. You have equipment of 34,000. So this gives you some number, 23,500 plus this will be what, 57,500. But you need to decrease this equipment for 16,000, which gives you here 18. Now you get some number here, and the difference would be cash of 12. So let's do this together. So for example, we know these two numbers. So that's 23,500. 23,500. And we know that equipment is 34,000 minus 16,000. Actually, you don't care if this accumulated depreciation for equipment or anything else. It just accumulated depreciation. You have to deduct it from your assets, period. So you have 34 minus 16, that's 18. So you have 18 here. So your total number is what? 23, 30, 41 point. Oh no, I copied it. This includes cash already. So I would say 8.1 plus 3, that's 11.3. 11.3. These two, right? These two. 11.3. 11.3 plus 18 is how much? 29.3. 29.3. So you would get to 29.3, but you know that your total assets are 41,500. How do you know? Well, because they have to be equal to this 41,500. Okay. So the difference will be what? Cash. 12,200. This would probably be not a basic problem, right? This would be a problem clearly that takes you a couple of steps, not just straightforward, boom, boom, one step. So you need to know a couple of things here. And so this would take you more than a minute. So this would be one of those problems that is not, there is a little bit more. So for example, here you have a couple of steps. So the question is, let's say, what's your cash? What's your cash? Well, you cannot just fake it and plug in whatever number you might guess. You know, you have what, 25% chance, multiple choice, 20, whatever the number of questions is, number of solution. So, you know, you have to know what retained earnings are. You have to know that then the total balance of 41,500. So you have to figure out first retained earnings. That is 34,700. Then you have to know that this number of 41,500 here is equal to your total assets. Okay, so now you know I'm looking for 41,500 total. How do I get to this total? Then you have to know that, okay, this accounts receivable, inventory, equipment, you need to know to deduct this accumulated depreciation, and whatever you get, I think we said what, 29 something, 300. The difference will be cash, right? So that would questions? Okay, this is a little bit longer problem. I'm going to just you will go over this problem on Blackboard in narrated lectures, but again, I will just point out. Okay. See, I deleted here 1, 2, and I go straight to 3. Why? Because these are all textbook problems, and because textbook, you know, the authors help you, right? They help you to get to the right solution by going step by step. So this would be a challenging problem, for example, for a number of reasons. One is just calculation time to calculate and everything. But second, more importantly, probably, is because because you would have to figure out immediately that you're looking for first for number of units to produce, and then base your materials on those units. You know, a lot of people, including anybody, including me, including anyone, you know, if you're not careful, if you're just kind of zoning out, or, and that's what, you know, also when people are practicing problems, you know, you kind of get into the kind of just some automatic behavior. So you feel like, well, I know this, but you're not actually thinking, you're just kind of copying numbers from your head, essentially, especially if you repeat the same problems. And don't do what I suggest always, mix problems from different chapters. So it's easy to jump straight into materials based on these sales, but that would be a wrong answer, right? And this is a very kind of long and detailed problem. I mean, there's not actually a lot there, but you get lost by the end. And then you jump straight into these sales here, and you start looking for materials based on these sales. But that's a wrong answer, right? But the authors help you by giving you one. What are the production units? Okay, so you answer this in terms of production units, right? In terms of production units. So you have here production units, you see. But if you're asked straight, what are the materials to purchase for these production units, then you might be tempted to jump straight into these sales, and then the answer will be wrong, right? Because as you can see, in July here, you have 36,000 units to produce, not 35. And then in August, you have 42,000 units to produce, not 40. And in September, you have 46,000 units, not 50. So of course, if you ask, let's say for September production units, or for the quarter, whatever, or July, August, September, if you're basing it on sales, you get the wrong answer. Now, you might figure out, if one of those answers that you get is actually within the multiple choice answers, or if there's no multiple choice, you just need to plug in number, of course, it will be wrong. Now, if you have multiple choice and one of them is there, then you feel I got it right, but it's actually wrong, right? So so you have to be careful. So that's kind of the thing with this problem. It's a long problem. It will be a challenging problem. Take some time to not to solve it again. Okay, so now we are reviewing this. So if you're following carefully and you do this, and okay, it's not a big deal again, because you're just going through procedures. Okay, I'm gonna look, but if the answer is not there, and then you get your number, and then you feel like I did the right thing, but answer is not there, then you know it's wrong. Then you might realize, oh, this is what's wrong, but you wasted already like 5 minutes, right? And yeah, I mean, a lot of data. This must equal 3,000 plus 20% of next month's sales. So it can get a little bit messy. This problem can get messy, but it's a good problem to practice. It's a good problem to practice. Now you are told that your cost 10 cents per and you're paying for in the following way, half paid. Now I made this, I think this is might be my addition or something to the problem. You know, these are the payments for your materials. It might be still part of the problem because we didn't do any cash payments here, actually. These are collections, production budget. This is just production budget in units. But these are the actual payments now here. And payments can be tricky, same like cash collections, right? You just be in reverse, in the opposite direction. Now we have to pay for things. So you would probably be asked what the accounts payable is. What the accounts payable at the end of let's say the end of the quarter, or at the end of October 3rd, or maybe I think I inserted maybe just, it doesn't matter. Additional month or something like that. So what do you need to pay? Well, you need to follow the policies, right? So half is paid in cash. What does it mean? Half is paid in cash. Well, that means then in the month of purchase, right? Month of purchase. So we have here 111,000, for example, for September. The materials needed. So how much do we actually need to pay for these materials in September? Well, let's see, 10 cents per, this is 111,000 pounds, I guess. So the total payments due are 10 cents, 11,100. But will you pay all 11,100, more or less? What? Well, for September you will pay what, 70%, because that's I mean half. I'm sorry, half of it will be paid in cash. So you will pay half of this amount in September. That's cash. That's 5,500, right? And then 30% in the month following the month of purchase, meaning 30% will come from August amount, which is 13,200. So 30% will be 4,620 will be paid in September, right? And then oh no, more complicated than this. Half of the purchase will be paid on credit, and of that half, 70, okay, so be careful. Let's say we are dealing with 11,100. 11.1 times 0.5. That's your cash here that you need to pay. Now, what else do I need to pay, you ask yourself, in September? Well, that's it for September, but I have to pay some things from previous months. How much? Okay, well, August total was 13,200. 50% I paid in August. Okay, 50% I paid in August. And then of the other 50%, how will I pay for those other 50%? Well, 70% I will pay in the next month, meaning in September, and 30% of those 50 I will pay in October. Okay, so now you have to be careful and say 13,200. 13,200 times 0.5. That's the other half. That's the other half of that is on credit, and then times 0.7, 70%, right? So 70% of this half of the total will be paid when? In September. And then 13.2 times 0.5 times 0.3, or simply the difference, right, between here, 6,600 and whatever the 70% is. So 70% of the half would be 46,200 that will be paid in September, and then 30% of that half would be paid in October. Okay. And what else do I need to collect? Well, if I'm going across 2 months, then it will be also July included in this. So I have here half of July, that's cash, and then the other half, 70% in August and 30% in September. So now these three together, that would be my payment in September. 11,925. So this would be a interesting problem. Again, a couple. This is here. This one here has an additional just stepping calculation, but nothing difficult in terms of concept or accounts payable. What else do I have to pay to others at the end of, let's say, the end of October here, 31st? Well, what is it that I have to pay still? Well, I will pay half of October, 6,900. I will pay it here. So definitely other half is accounts payable. I have to pay to somebody else. So I put it here again, split it into November and December, but the total will be the same as this, just a half, right? And then I have to pay what? So I go step back and I say, well, September, half of it I paid in cash in September, but the other half, 70%, I paid in October. So that's not accounts payable, but 30% of the half is accounts payable. So that's 1,665. And then again, just to be safe, you can go another month, step back and say, okay, half of August I will pay in August. 70% of the other half I will pay in September, and 30% of the other half I will actually pay in October. So that's not accounts payable. So only these here are accounts payable at the end of October. Again, it's reverse situation, just reverse thing, but the same idea as when you're collecting your money. Okay, any questions? Okay. Let's see what's going on here. Sam, thank you. Okay. Let's go to chapter 9. Let's go to chapter 9. Chapter 9. Let's go straight to exercises. You will go through the lecture on your own. Let's go through the exercises, and then I will actually try to cover the chapter through these exercises. So chapter 9 is actually a very interesting chapter, flexible budgets. So we are looking at variances, what actually happened versus what we planned it would happen, right? What actually happened versus what we planned it would happen. So there will be some variance there. We are not perfect. We will not predict things perfectly. Now, since this is still a budget, even though it's called flexible budget, we will use those functions that we used in our planning budget. But by functions, I mean how much we will pay per unit of something, $3 per pound, how much fixed cost we will have, 10,000, how much we will pay the people who work, wages, $10 per hour, and things like that. So those things will stay the same, right? So that will be a portion of our flexible budget. Let me go to the lecture actually quickly, just to point out main things. Okay, so this is the main domain, basically the summary of our whole chapter 9. And you can see the chapter is very short, 17 slides. I give you some examples here, and one of these is from your textbook. I go through this in detail. So that should be fairly clear what favorable and unfavorable variance is. And then we have multiple cost drivers, and we will go through this now in exercise. But this is really, this slide here is basically the chapter, right? Summary. So in chapter 8, that was a planning budget that we did, and we had some level of sales. We always start with sales. So activity is very important to us, right? What did we get the activity right or not? Most of the time we will not be perfect. We will say what will be the activity, right? So we had some estimated sales, but they were static, right? It was just a number. Static meaning they're not changing in that budget. They're steady. Everything is based on one level of sales, not the same level of sales for each month, but whatever we decide, that number will stay there. Now, how do we compare actually when we get to the end of the year and we get actual results? We get the real thing, what actually happened. How do we compare this to our budget in terms of performance? See, because this second part of the class it deals a lot with, so in the first part of the class, we always deal kind of with performance in this class. So that's why I say, this class is different and should be a little bit more interesting to you. You're not accounting majors, but how do you look at things? Am I doing well or not? And it's about controls. It's about measuring your performance, but it's also about projecting things. So planning. So how do we now evaluate our performance? Variances are part of the performance management. Right? We will work on performance management on a different aspect in chapter 10, but we are now already in performance management. So chapter 8 was budgeting as a kind of a planning phase, but chapter 9 is actually evaluating how well did we do. So how do we now compare when we get to the end of the period and we looked at our actual results? How do we compare this to the planning budget and say how well did we do? It's hard to compare because the level of activity is different, right? Level of activity is different, and numbers are all different all over the place. Now, can we just say easily, well, the numbers are different simply because the activity is different? Well, sure, the activity is different and numbers are different. But are the numbers different just because the activity is different, or there is also something else? So that's the idea behind the flexible budget. The flexible budget should separate things, weed out things like, did this happen just because the activity was different or also because of something else? And again, so I'm not going to go through the whole chapter here, but I give some examples here. For example, very simple, straightforward example. So if we said we were going to sell a certain number of units, and then we sold more or less, and then we get the number at the end for our revenue and expenses and everything else, and then we say, okay, so this net operating income is different just because we sold less units. Now, of course, sometimes it will be easy to say yes, because the things are very simple, right? I plan to sell 10 t-shirts, charge $10 for each one of them, and they cost me $2, so that's $8 profit for me, and I have no other expenses. Well, and I plan to sell, what did I say, 10 t-shirts? Well, okay, so I should make $80, right? $80 in profit. Now I sold only 5 t-shirts, and I know I paid $10 for them, and I'm sorry, $2 for them, and I know I charged $10, so I charge $8 profit again per t-shirt again, but times now only 5 t-shirts, so that would be $40, right? So, well, now it's easy for me to say, well, of course, my profit now is lower than what I expected or budgeted because the activity was just different, right? I did not sell 10 t-shirts, I sold only 5. So instead of making $80 profit, I made only $40 profit. That's easy, right? So that's not a problem. But of course, things are more complicated in real life and in real business. I shouldn't say real life. Maybe you're just selling it on the street fair. So that's real life too. But it's kind of very straightforward, very simple. But you have more complicated business with many different products or factors involved than just how much you pay for a t-shirt or how much you sell it for. So now you ask yourself, did my net operating income come out this way because of this activity was higher or lower, or because other things, right? And flexible budget will tell us that there are other things. That's why we are doing it. There are other things. Otherwise, everything would be everything would be easy to figure out if we just compare. If we just base everything on the activity, but we would be misled easily, right? We would be misled. We would say, well, we did well or not. Again, so you will go through the example in this lecture. But the way to think about flexible planning, about this chapter, I should say, is when you start working on problems, is again to develop some kind of method and way to go about this. So we will convert our static budget into flexible budget. How will we do this? We will simply use actual activity versus the estimated activity, but we will use those same functions, right? Same functions that I said earlier. Estimated prices per unit, estimated cost per unit. If we use these same estimates, functions from our planning budget, $10 per pound, $15 per hour, the worker, fixed cost for electricity is $7,000, etc. If we use those in the flexible budget, but then multiply it by actual activity, then we will see what the numbers are, right? And then we will be able to see if the difference is coming from the activity or if something actually happened with our functions, right? If we actually charged $10 for that t-shirt or not, that I was talking about before. Maybe we charge actually $9. Because if we sold less units or more units, and we multiply it exactly by $10 that we plan to do, then we should get a certain number, very specific number. But if this number is different now, that means it's not just the activity, but maybe we actually charge $9 per t-shirt. Why? Maybe because we sold them on discount. Somebody came and said, you know what, let me get 5 t-shirts. Or we told them, okay, t-shirts are $10 each, but if you buy 5 of them, I'll give you each for $9. So you will save $5, right? So you can see that the difference might be actually in those functions. But in the flexible budget, we will use the functions from the planning budget. So the numbers then should match, not match be the same as the ones in the planning budget, but match with the actual activity, whatever the activity happened. It will become clear when you start looking through the chapter. Okay, variances. There will be favorable and unfavorable variances. This is just common sense. The word says favorable, something good for you. So those will be good variances, something that is good for your net operating income. Whatever variance is good for your bottom line, net operating income, is favorable variance. But this is not math minus plus, right? What is good for you and what is bad for you, for your net operating income. So if the variance is good for you, meaning, let's say your cost, is it good that your costs are lower or higher? Well, it's good that are lower. So if you then you anticipated or you expected or that it should have happened, that would be a favorable variance. And same thing, with revenue. Is it good that your revenue is higher than anticipated or that should have happened when you do when you include your actual activity? Well, that's a good thing. So that would be favorable. And of course, unfavorable would be what is not good for you. So we see here, yeah, the question is how much of the revenue variance is due to higher activity or lower activity, and how much is due to price cost control, those functions that I talked about. So flexible budget is a very good thing, actually. It's a very interesting thing and useful. So the relevant comparison will be between actual results, what actually happened, and flexible budget amounts, what should have happened at the actual activity level. So the way I like to say this is the flexible budget is a combination between reality and fiction, in a sense. Fiction, as much as planning budget is a fiction, right? Planning budget is something that we just imagine. It's based on some past things. It's not like it's complete fiction, but you know what I mean. It's not reality. Did not really happen. Our projection, right? So the flexible budget is a combination between planning budget, those functions, that's fiction, and reality. Reality, what actually happened in terms of activity, right? So you can remember it that way too. So when we are comparing actual results, we are not comparing actual results to planning budget. We are comparing actual results to flexible budget. When we are comparing actual results to flexible budget, we are comparing what actually happened in the period, meaning we just get the numbers. These are the numbers: net operating income, how much cost, how much revenue, etc. And the flexible budget amount, because flexible budget will include, again, this combination between planning budget and actual activities. So it will be kind of in between. It will cross this bridge between actual results and planning budget. So it will be a bridge in between. We should remember that total variable cost change in direct proportion. We know this with more than one activity driving, and the total fixed cost. So you might have more than one activity and driving things. That will be at the end of this example with multiple. So this is the way to set this up when you're working on problems. You're always looking at three things. First, you always start with, when you see a problem, the flexible budget problem, you always remember, you don't know where to start from, a lot of numbers, this, that, left, right. What do I need here? I need flexible budget, period. I need flexible budget because you're given some planning budget things, and you're given actual results from, for different items or the whole thing, income statement. So what do you do with this now? Well, you just remind yourself, I need flexible budget. Boom, flexible budget. Okay. When you remember you need flexible budget, now how do I create flexible budget? Well, I use planned estimated functions. I use plan estimated functions from the planning budget, those $10, blah, 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 $3. I'm selling this for $5. I'm buying it for $1, etc. And I'm using actual amounts in terms of activity. Actual amounts in terms of activity. Well, actually, this bullet here is actual amounts total. But I'm using actual amounts in terms of activity. Maybe I should update this to be very kind of clear. Actual amounts, what actually happened. No, well, this talks about also comparison between flexible budget and actual amounts. Well, I say here actual activity. Okay. So to create flexible budget, you do combination of these planned functions and actual activity. Where will you find actual activity? Well, you will find it in actual results. Net operating income, let's say, at the end of the period. Where will you find planned functions? You will find them in a planning budget. You will combine the two to create flexible budget. Now that you have flexible budget amounts, you compare those amounts to actual, what actually happened, actual amounts. Okay, so this is what I mean here. You're looking at three things. Three things are planning budget, functions from the planning budget. One, you will use them to create flexible budget. You're looking at actual results. You will use portion of activity also to create flexible budget. And you're looking, yes, at flexible budget. So that's the third thing. You always need flexible budget. So once you create flexible budget, you will simply compare the relevant comparisons between actual amounts, what actually happened, and flexible amounts, what should have happened, that level of activity. Okay. So let's go to some, to a couple of problems. Okay, so we have this school. For example, the school might run two courses. They're running courses, cooking school. And they have some data here. So they might run two courses and have total of 50 students enroll in two courses. So the question is, what's the planning budget for September? Well, actually, let's see what the next question is. The question is, what's the revenue and spending variance for September? That would be a better question. A planning budget is just planning budget, right? Planning budget is just, well, what's the planning budget? How many students do they anticipate? For example, administrative expenses should be 32 cents, 100 per month. And this is explanation for these things here. Okay. And it says here fixed cost per month. So they're explaining here just how this is set up. So fixed cost and then cost per course and then cost per student. So the bottom line is they have some fixed expenses. So for example, admin expenses will be 32 fixed, and then there will be $15 per each course. So if you're running one course, you multiply that by 1. If you're running 5 courses, it would be 5 times 15. And then cost per student, depending on how many students total. So that would be, for example, admin expense, right? So we can see here admin expense, $32.70 fixed cost plus $15 times 3 courses. The company plans to run 3 courses. So that's a budget, planning budget, 3 courses. And they plan to have 45 students. So we'll multiply $4 here by 45. Okay, so this is a planning budget. Most of the time, this is not a question in a flexible budgeting chapter, let's say on exam or in your homework, or because this is just a planning budget. That's the point of this information here is not this, because we don't need this. We said earlier, a second ago, what do we need to compare what to what? we need to compare flexible budget to actual results. Flexible budget to actual results. This is a planning budget, so we don't need this to tell us how well we did. But what we do need from the planning budget is this. These are the functions, right? These are how much are the utilities, planning budget. It says here formulas. That's how the textbook and authors are calling it, formulas. You can call it formulas, equations, functions, whatever you want to call it. Basically, you know that these are the functions given in a planning budget, $870 fixed plus $130 per course, and nothing per student, because these are utilities. Supposedly students will not, it doesn't change with student number. The utilities or admin expenses do change. You have more students, each student will use $4 for admin expenses. Insurance, you see, does not change in terms of students or course. We have to pay no matter what, $18.90. So these are those functions that we will use for what? For flexible budget. For flexible budget. Now, what number will we use? What else do we need for flexible budget? So again, this is, well, okay, so this is the question here. Let me look at the next slide. These are the actual results that we are given, and then flexible budget. Okay. Okay, we have those functions here next to it, so I can go straight to this slide. Let me erase this. Okay, so for example, this is the question for us. Calculate the revenue and spending variance for September. So revenue would be here, revenue, right? And what else? Spending variance. Spending variance would be all of this. So the question actually might be, you know, what's the net operating income variance? What's the net operating income variance? Okay, so this is the question here. Yeah, I mean, we would be given probably this in this format here. That's how it's likely in the textbook. I have to split it into 2 slides because there's no space, and because of this question of planning budget. But we would be given, for example, in this format, right? These are the functions from the planning budget here. Now, how do I answer this question? Well, we said the first thing you remember is I need flexible budget. I need flexible budget because I will compare flexible budget to actual results, not to the planning budget, not to actual results. How do I create flexible budget? Well, we said we create flexible budget by using functions from the planning budget and actual results. I mean, actual activity, actual quantity. So you see here, the company planned to run 3 courses with 45 students. However, it actually ran 3 courses with total of only 42 students. So now you have to be mindful of this. It could have been here, instead of 3 courses, 2 courses, right? So you have to be mindful here and know that you need to use this number, 42 students. Yes, and this number to 3 courses, that stay the same as here. The bottom line, you need to be mindful that you need actual activity, actual activity. So this is the function, $800 revenue per student. How many students? Not 45. That would be in a planning budget. But we're talking about flexible budget, so it's 42. So we have 800 times 42 students. We have $33,600. So that's the, this is how much we should have made. Remember, flexible budget is what should have happened at the actual activity, And what's the actual activity? Anybody awake? Let me see if anybody's still awake there. What's the actual activity?
42 students instead of 45.
42 students, very good, 42 students. The actual activity is 42 students. So at 42 students, according to our planning budget says that we will charge $800 per student, right? $800 per student. You see in a planning budget, $800 is used here. We will charge $800 per student. This is our planning budget. So we will use these 800 in our flexible budget, we said. So we will use 800, but we will multiply it, of course, with actual activity of 42 students. So what we should have in our pocket in terms of revenue is $33,600. But the actual result, and how many students are in this actual result? How many students are here?
42.
Very good, 42 students. It's the actual result, right? This is what actually happened. So these are 42 students here. So see what we did with flexible budget, we brought everything to the same level. So now, if you should have charged $800 for each student, and you use 42 students here, and you get 33,600. But the actual number, your revenue, not cash, or it's not like we did not collect on it. We're talking about the revenue, is 32,400. How is this possible? What happened?
Decrease in students.
It's not decrease in students. We just said that both here and here are 42 students.
Maybe you didn't
charge them less. 800.
Huh?
You didn't charge $100.
We did not charge 800. Very good, excellent. So you see how flexible budget tells you. The flexible budget tells you where. So what's the difference basically? The difference is $1,200 negative. Why negative? Unfavorable, not negative in a mathematical sense, but unfavorable, not good for you. Why? Because you should have made how much? 33,600, but you actually made 32,400, which is the difference of $1,200. So remember, flexible budget is kind of ideal thing, what should have happened at the actual activity. But what actually happened is you made 32,400. And why? You ask yourself why, and I ask you now why, and somebody said because less students. No, the students are the same. There are 42 here and 42 here. So then somebody says, because we did not charge 800 actually. This is the actual real life. And that is correct. So you see how flexible budget tells you that maybe your revenue, actual revenue here, 32,400 is not 32,40. Let me go back to the previous slide. So your revenue should have been what? 36,000, right? 36,000 according to the planning budget, $36,000. But it's actually 32,400. And you might say, well, it's lower. It's 32,400, not 36. Just because of what? Just because of what? Because of less students, right? Because we plan to have 45 students, but we actually have only 42 students. No, that's not why. Well, in part, yes. In part, yes, of course, because 45 students, you should have had 3 students less. But in addition to these 3 students less, your revenue is lower than should be even at 42 students. How do we know this? Well, because we used 800 from the planning budget. We multiplied by 42 and we got 33,600. But this is still less than 33,600. For how much? For 1,200. Where is this variance coming from? Well, this variance is coming from we did not charge 800. Why? Why didn't we? Well, that would be for you to investigate then, right? Well, investigate. This is also a very simple example. You would just say, why did we? Whoever is running the course or whoever is responsible, or if you're running it, you would know why, because you gave a discount to some student maybe who signed up late, or maybe the student won a free course from somewhere, some website or something, some promotion. So you actually did not charge the student and things like that. So this is why you would have $32,400. Basically, you're short $1,200 from what's the total shortage? Well, the total shortage is what from your projected revenue is what 3,600. 3,600. Okay. So you might say, if you want, that 3,600, we don't care about this comparison for this job, but here we are kind of just playing with this and discussing learning things. Okay, so the difference between 32,400 and 3,600, not 3,600 but 36,000 from your planning budget is what? $3,600, right? 3,600 plus 32 is 36,000. This is your planning budget. Planning budget. We don't care again about this comparison, but anyway. So you see this total variance between the planning budget and the actual results is 3,600. But 1,200 of those 3,600, 1,200 of those are what is responsible for 1,200? Price. We did not charge $800 per student. Or again, maybe we gave some discount, or maybe we would one student was free, but basically we did not get average of $800 per student. And then the difference here of $2,400 is coming from where? It's coming from where? Anybody?
Other changes in costs?
No, we're talking just about revenue here.
Oh, okay, sorry.
So 2,400 is coming from where? Students, very good. Mansureh, very good. Mansureh. The 2,400 is coming from the difference in students. We planned for 45 students. We actually had 42 students, so that's 3 students difference. 3 students times $800. $800 is $2,400. So this is why we have number here, 33,600, right? 33,600, which is 2,400 less than 36,000. And that's that will be the difference just based on quantity, activity, 3 students. But we have additional variance here because of price, 1,200. And this is what we are interested in. Why? Because it's easy for us to see that we made less money in terms of revenue because we had 3 students less. That's not a problem. That's easy to see. But flexible budget will tell us what other things contributed to, if any, variances. And in this case, there's variance that is unfavorable. And why? Because this is different. This is different. Because we are bringing everything to the same level, right? So again, so you go through step-by-step procedure and you say, okay, let's go to the next problem, and then we can finish. Next problem, and again repeat the procedure, repeat the steps. Okay, so we have here this gelato thing, and we are looking at, remember, these are the solutions here on the right side. So we are given this, right? We are given this. Okay, so you have fixed element per month. These are the cost formulas and actual results. These are the actual results, actual total. So you're careful, you're reading, you're looking for things. And these are the planning. This is from the planning budget. Okay, so you are asking yourself, what do I do with all of this now? I need flexible budget. Number one, I need flexible budget. Number one, how do I make flexible budget? I make flexible budget by using functions, formulas from the planning budget, and actual activity. That's it. That's your procedure. That's your, leave this actual total for a moment alone. Okay, unless the activity is somewhere hidden here in the actual total when you see the problem. But otherwise, leave it alone, because you don't need it yet until you need to compare things. Just create your flexible budget first. Okay, so now let's create flexible budget first. Revenue. What's the function? Revenue is $12 per liter. $12 per liter. How many liters? Well, let's see how many liters. Sold by the Conocapula, for example, wages should be 5. This is all explanation, which you wouldn't get usually in exam. Sold and actual wage. Okay, so this is all not there. Via Gelato expected is expected, or Via Gelato expected as a planning, expected to sell 6,000 liters in June, but actually sold 6,200 liters. Which number will you use here? Well, this is from the planning budget. You don't care about it. You care about actual results. So you say 6,200, and you use the 6,200 here, and these $12, and this will give you $74,400. Okay, let's go to the next. Let's go some other item. Let's say utilities. Let's go to wages. Okay, wages are fixed, $5,600 plus $1.40 per liter of gelato. Okay, so 56 plus 140 cents times 6,200. Again, actual activity. This will give us wages of 14,280. So this is, we go down to all the all items, and we get our net operating income of 21,650. Okay. So now the question can be any item here, any item or total net operating income or whatever. So any item. For example, if the question is, what's the variance for utilities? You don't need to do all of these things, just wasting time, right? But if the question is, what's the net operating income variance, then you have to do all of these and compare them to actual results. Okay, so you did your flexible budget, you see. You used these functions for 65 here, which is here per liter, and use actual activity. Some items are fixed, just fixed. They're just fixed. Now, which, if you have here, if the fixed item is different, fixed item, let's say 1350. If it's different and it's 1350 here in actual results, which amount will you use? Let's say it's 1,400 here. Let's say it's 1,400 instead of 1350. Which amount will you use here in a flexible budget?
The one from the planning budget, the 1350.
Very good, Mitchell. Excellent, excellent. Why? Because we said you use functions or items, these formulas from the planning budget, not from the actual results. You're comparing it to actual results. So you would use 1350 here. You would use 1350, even though it's 1500 or 1400. Now you might ask, you will see in the examples in the main slides. You might ask, well, it says it's fixed. How is it possible to change? Well, we know that fixed items can change too, right? They are not changing because of activity, but they just change. The bottom line is you would use flexible planning budget amount in your flexible budget. So now you get flexible budget amounts, and now you can compare it to actual result and say, okay, at 6,200 liters and $12 per liter, we should have made $74,400. So we have a similar situation as before, but we actually made, these are the actual results, 71,540. Is this good or bad? Well, some students will say this is good because we made more money. But remember, flexible budget is not what actually happened, but what should have happened. So this is what actually happened, 71,540. So this is not good, even though you feel like, well, this is a higher number. Yes, it's higher, but again, this is still not full reality. It's reality just based on these units here. But this is not full reality. Reality is 71,540. So 7440 is just what should have happened. So clearly this tells us that 2860 is missing. Right? Why is it missing? Well, maybe somebody just pocketed it. Maybe somebody just took cash and put cash into their pocket every day, $100, and just went home happy, right? So $3,000 is missing, right? But likely, that might not be the case. Maybe we were charging less than $12 per gallon, because maybe we were selling it wholesale to a large customer, right? Maybe we sold 1,000 liters at less than $12. Maybe we sold 1,000 liters at $11. That's already $1,000 here, and then we have another 1,860. So that's a kind of a similar example as before. So you see the difference here is actually in price, how much we charge. And then you can go through other items. So for example, again, wages here are actually favorable. At 6,200 liters and our functions, we should have spent $14,280. $14,280. But we actually spent $13,860. How is this possible? Well, if the fixed elements stay the same, so clearly we paid $5,600, but something here, maybe we spend less than 140 per liter in terms of wages. So we would investigate this, right? Maybe actually one worker left and we did not spend $5,600 for the fixed wages, but we still covered our sales, 6,200 with other workers. So we would look at this, but the bottom line, it's good for us. We did not spend as much as we should have spent at this level of activity. So that's favorable, it's good, right? And again, don't look at this in a math sense. So you say 13,860 minus 14,280 is a negative number. That's not good, unfavorable. No, in terms of cost, that's favorable because your cost is lower, right? And the bottom line is net operating income is unfavorable variance. Unfavorable variance. Even though we sold more gelato than we thought we would, actually we made less money than we should have. We made 21,650, but we should have made I mean, we should have made 21,650, but we made only 18,640. So that's that. Any questions? Homework is due, I think, tomorrow for this chapter, right? So you should have gone through this already.